Welcome. Thank you for attending today's Refinitiv webinar. I'm Andy Holm, metals columnist at Reuters, and I'm going to be your moderator for today's session, where we will be looking at the copper market. This is a propitious time to have this conversation. A London Metal Exchange copper has this morning traded up to $9,999.50. Before we get going, as is customary, let me go through a few housekeeping items. At the bottom of your screen, you will find multiple widgets for you to use. All are resizable and movable, so feel free to move them around to get the most out of your screen space. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try to answer these questions during the session, but if we run out of time, they will be answered later via email. We do capture all your questions. Today, we will be using interactive polling during the session, so please do participate using the polling pop-up window. Additional materials are available in the resource list. Please download those you may find useful. You can find out more about our speakers today by the speaker bios widget. For the best viewing experience, we recommend closing any programs or browser sessions running in the background. This will help conserve your bandwidth. The webcast is being streamed through your computer, so for the best audio quality, please make sure your computer speakers or headset volume is turned up. Some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. If your slides are not progressing, try pushing F5 on your keyboard, and that should refresh the page. We value your feedback, so please do complete the pop-up survey at the end of the webcast. We will be recording today's session, and an on-demand version of this webcast will be shared in the coming days and can also be accessed using the same audience link that was sent to you today. So, with that out of the way, I am absolutely delighted to introduce our speakers. We have Bruce Allway, Director of Metals Research at Refinitiv. We have Bernd Sischka, Head of Buy-Side Sales at the London Metal Exchange. And we have Aline Carnizelo, Portfolio Manager at Parlour Investments. So let me, if I may, to start by setting the scene. A quick reminder from Thomson Reuters lawyers that any views I express today are my own and not those of my employer. So why don't we go straight into a very simple question for polling. The price today, 50 cents short of $10,000 per ton. Do you think it will be higher, lower, or the same level at the end of 2021? Please submit your answers now. Okay. It looks that we have a few super bulls out there. We have 2/3 looking for higher prices. Okay, as I said, by way of introduction, let's just discuss the title of today's webinar: Super Cycle or Spin Cycle. So I can date the start of this super cycle debate to a piece of research that came out from Goldman Sachs in November last year. 2021 Commodity Outlook, revving up a structural bull market. And Goldman said that while the vaccine presents tactical upside, the pandemic itself represents a structural shift. Quote, looking at the 2020s, we believe that similar structural forces to those which drove prices in the 2000s could be in play. And just to remind us all what happened in the 2000 super cycle, that's on the left-hand side of the chart. It was a transformation for metals pricing. I've been in this business a very, very long time. I started in the 1980s. During the 80s and the 90s, there was a rock-hard consensus that copper could not trade for any extended period of time about $3,000 per ton. It was just an accepted, almost law of the market. That was blown away during the super cycle of the 2000s. Transformational for prices. Goldman contends that we could be in for a similar transformation now. It's a really interesting report. It's a very detailed report, but let me try and boil it down to a couple of key reasons why Goldman thinks that this is not just any normal cycle. So again, the quote from the report, COVID is already ushering in a new era of policies aimed at social need instead of financial stability. This will likely create cyclically stronger, more commodity-intensive economic growth. And I thought to illustrate this point, I'd look at sort of like how the Eurozone recovered from the global financial crisis and how it intends to recover from this financial crisis, right? Or from this social crisis. And on the left-hand box, for those of us who are around, you'll recall the rolling bailouts of Greece, Ireland, Portugal, Greece again, Spain, Cyprus. But I really want to draw your attention to the last bullet point. National governments injected almost 750 billion euros into 114 bank bailouts up to 2015. Not 1 cent of that did anything for commodities demand. Now let's look, how the Eurozone is looking to sort of like for a social fix for what is a social crisis. And this on the right-hand box comes from the European Commission's recovery plan. Look at the emphasis on social cohesion, social impact. And President von der Leyen saying we need a Marshall Plan for Europe's recovery. This recovery will be completely different from that or from the financial crisis. And here's the second key point, it's going to be green. So again, quote from Goldman, decarbonization represents an increase in the capital intensity of the global economy, comparable to the effect of the BRICS boom of the 2000s. And again, I just wanted to drill down a little bit into the EU recovery funds and sort of like lay out some of the key metals intensive aspects of the recovery, right? And then look on the right-hand box, individual countries are already putting together their own green recovery packages. And the one I think is really significant is Germany. It's raised its subsidies on electric vehicles to 9,000 euros. And it also stipulated that all petrol stations will have to offer EV charging capacity. Interestingly, there was not €1 for the traditional internal combustion engine vehicles. So now we have, I would say, a global alliance of decarbonisation. From China's point of view, Xi Jinping's sort of a commitment to carbon neutrality last year was a game changer. He doubled down last week during the Earth Summit Day and committed China to peak coal consumption during the current 5-year plan, with a phase-out starting 2026. Of course, meanwhile, the US has completely reversed policy on this. The Biden administration has recommitted to the Paris Agreement, committed to carbon neutrality, 50% by 2030. We don't yet know quite whether he can deliver his proposed $2 trillion green infrastructure plan. But the key thing here is all the big trading regions and blocks are moving in the same direction. And as we all know, going green is going to take a lot of metal. I pulled this out of a World Bank report last year, which looked at just the issue of what the world needs to do to change its power source. So not about the infrastructure, not about EVs. This is just about decarbonizing the world grid, if you like. And one of the findings was that just to do that, we're going to need cumulative copper demand growth of 30 million tons through 2050. So that, in essence, I think, is what Goldman's argument is here, right? I still have a little problem because what you see in this chart is I've tracked the copper price against what I regard as the real driver of the price for the last 15 years, which is the Chinese manufacturing impulse. So the copper price is in yellow. You see the national NBS manufacturing PMI in red and the new Caixin manufacturing PMI in blue. I would just invite you to make the comparison between the price reaction to the global financial crisis of 2009 and that we are seeing today, and to ask yourself, does it look that dissimilar to the old China narrative? And even if it does, can we have a metal supercycle without it being a commodity supercycle? And I'm going to leave those questions hanging there a little bit. as we move on to Bruce. Bruce is going to sort of give us, I think, a drill down on the supply side. So, Bruce, I'm going to hand over to you now.
Thank you, Andy. Yeah, very interesting. I want to do that poll again, your first slide, to see how many more people are more bullish. But let's go back to the beginning. Right, so copper supplies and flows. Yeah, really just two parts here today I want to go through. I'll talk about copper mine supply. What does the footprint look like? To remind you, most of you know where copper comes from, just very briefly. Growth rates, quick look at the pipeline, and then we'll have a think about COVID impact. Long COVID, is that still an issue? And also we'll talk about Q1 downgrades. Then quickly on copper flows, back to China. As Andy says, we'll look at copper concentrates and refined copper imports, and then a drill down into Chile and Peru, some more detailed charting. Okay, well, copper mines, here's the global footprint. Here's the sundial or sunburst chart by region, sub-region, country, and mine. And we're all pretty familiar with this. There's the regional breakdown. Americas, 54%, Asia, 20%, Africa, 11%. And I've just hit the top 10 mines for you there: Escondido, Collahuasi, Morenci. I mean, Escondido is about 5% of global. The rest are between 2% that you see here. So, you know, this is why Escondido matters when things grind to a halt. The Americas, Chile, of course, world's largest producer, 50% of output from the Americas. But Peru is really the kind of growth story. You know, output is up by 2/3 from 2012 to today, and we're forecasting another increase of about 30% over the next 3 years. So Peru, it continues to grow. Africa, that's another hot spot I wanted to highlight. DRC and Zambia, big players in Africa. DRC is about 50%, and another growth story, of course, with output to increase by around 40% over the next 3 years. So there's some big beasts out there. So what does that mean? Here is our supply outlook. It's quarterly data. At the top chart, I've just done the relative growth, and I've indexed it from, sorry to be over confusing, I've indexed it from Q4 2020 to 2023, just to look at the 3-year growth period that we're looking at today. And I've done a relative growth, and of course, thinking about that footprint, the absolute growth. So strong growth in Africa, yes, but the biggest contribution coming from the Americas, and of course, you know, I've mentioned Peru. Okay, time for a poll. All right, we're going to talk about the pipeline supply, so I thought this would be a relevant poll. What is the copper price required to incentivize the new mine development? I don't want to give you too many clues, but obviously it's cash costs, it's sustaining costs, it's capital, and it's a return on capital, because you ain't going to build a mine if you get nothing back from it. So let's have a number, please. And I'll just give you 5 seconds, no, 10. Just give it a little bit more time. We've got a good engagement so far. I'm seeing the numbers tick up. Okay, it's only 3 choices, people. Just click. Okay, let's see what we've got. Wow, good. Well done, everyone. Basically, well done, 56% of the population. 7,500, yeah, correct. $7,500 per ton is the, you know, average kind of incentive price for new mine production. And of course, with prices languishing below those numbers for so many years, you know, it's not surprising there's a shortfall in copper supply forecast. And, you know, that is obviously a big narrative, along with, you know, Andy's China theme and super cycle. You know, supply constraint is a massive, you know, narrative in the bullish copper story. Well, we do have a pipeline, of course. And here again, I don't want to overdo the sundial charts. Here's the construction feasibility outlook for you by country and mine. I just want to highlight the DRC miners. We've been talking about Africa. The Kamola-Kalula copper mine, joint venture Ivanhoe. No surprise there to see China participation. Obviously, there's a structural short in terms of copper supply for China. They're investing heavily in Africa and beyond. So there's a lot of engagement there. Processing July 2021 with initial mining rate of 3.8 million tons per annum. An average feed grade of a remarkable 6% copper. Okay, so what does that pipeline look like on a kind of time series? Pretty straightforward. So under construction and those projects in feasibility, you're looking at about 500,000 tons over the 3-year production forecast. Okay, that covers the mine production kind of element. Now let's think about COVID. This is something we've been maintaining since the start of the COVID outbreak. You've obviously seen suspensions in a number of mines. You can see the axis there, peak in Q1 2020. There was a second phase coming through. You can see that in the green, but it was pretty muted. And I'd say more or less, we're clearly over the worst of it. And certainly South Africa is really the epicenter with regards to, continuing reduced operations. Those of you who know mining, of course, South Africa is a kind of deep level, labor intensive mining environment, much more difficult to manage the virus in that kind of environment than, sitting in big yellow trucks in open pits. So in terms of the impact on copper, not a big story in 2021. Very briefly, I just want to talk about the Q1 2021 production results. So those of you with ICON will be aware the mine production screener, MPS. This is basically the screener to our quarterly database, global database. This shows you copper and it shows you the revision log. So essentially, as companies report, obviously we're updating the database. And in Q1 2021, you can see the last 30 days. And this is updated daily. We've captured about 30 companies that have reported so far in the first quarter, and we've basically shaved off 100,000 tons of copper from our existing forecast. So that's down about 2%. So it hasn't been a great quarter. So I would argue again, maybe the downside, the downside risk to our forecast for the year is lower, but then again, it's quite a generous forecast. Okay, second part of the presentation, I just want to talk about some of the flows, copper concentrates, etc. So here, of course, copper imports to China. Left-hand side, copper concentrates. 2020, 21.8 million tons of copper concentrate imported, 1% lower year on year. That is the first year-on-year decline for a decade. Why? We've already mentioned, obviously, you've seen the COVID-19 related mine production curtailments in South America, largely Peru. There was a big influence there, and we're over the worst of that. You can see in 2021, in kind of purple, copper concentrate arrivals in Jan to Feb, 3.8 million tons. That's less than 1% higher year on year. So, as I've mentioned, this is not about long COVID. This is rather the effect of a combination of weather-related deferrals from Chile concentrate arrivals and the embargo on Australian concentrate imports. And as you can see in March, in fact, things have already picked up. So for the first quarter, we're now looking at imports of around 5.9 million tons rather. That's about 7% higher year on year. And we anticipate, to see that kind of level of imports as we move through the year. Obviously, we're forecasting higher mine production. So hopefully that copper concentrate tightness we've seen in the first quarter starts to ease. And you've obviously seen that tightness reflected in the treatment charges, which have absolutely tanked. Refined copper, right-hand chart. Clearly, 2020 sticks out. 2020 imports as a whole, 30% up year on year. If you look at the kind of average run rates, that's about 1 million tons above usual. According to BGRIM, it's a China-based metals consultancy. This is a rumored restocking by the Strategic Reserve Bureau, SRB, which does what it says in the tin. It basically is in charge of building the country's strategic reserves. So BGRIM estimates by the end of 2020, there was a 1.2 million ton surplus of copper. That's sitting somewhere on the sidelines. I'm sure Andy will have something to say about that. I mean, in terms of acquisition price, if you look at the period from June to September, you know, you're talking copper $5,500 to $6,500 a ton. Certainly looks attractive basis previous purchase patterns. So Q1 then, given into 2021, in purple again, million tons of copper, of refined copper imports, that's about 0.5% higher year on year. So we're kind of back to norm. Okay, final bit. Let's just very briefly have a deep dive into Chile and Peru. We've got some detailed data on shipments and impurities. So I just want to flag a few kind of structural changes here as well. So right-hand side, you're obviously seeing copper concentrates gross weight from Chile exported and the average grade. This is, you know, well known. I mean, it's a long time series. Grade obviously declines as assets mature. However, it is still 27%, but clearly just to stand still in terms of copper volumes, you've got to move more material at those kind of grades. So that's the kind of Chile story. You're fighting to stand still, really. Peru, as we've said, is a kind of younger copper industry. The assets are obviously younger. That's in a growth phase still. And you can see grades are still stable. Obviously, in the future, that is the question mark, but it is 25% versus 27. So, you know, overall, it is lower. Let's talk a little bit about impurities, some of the nasties. Arsenic. You know, I think this chart is pretty instructive in terms of total arsenic in concentrate. Obviously on the rise. Geology is getting more complex. We're obviously developing projects where the mineralogy is more complex, and arsenic levels are rising. Any concentrate with arsenic above 1% does require blending to obviously maintain safe emissions. Arsenic emissions are not pleasant. What else is not pleasant is I guess mercury, fluorine, bismuth, and cadmium. And again, you can see here shipments from Chile and Peru with impurities over that threshold. What's the theme? Again, you know, as we've seen the acids and the mineralogy get more complex, we've seen more impurities. And I think obviously Peru is a different, you know, mineralogical footprint, if that's even a word, to Chile in terms of the geology, which is a bit more complex as well. Okay, that's it. Let's sum up. What have we learned? We have learned that we think mine production is going higher. You know, after 2 years of decline, we're forecasting an annual growth rate average of about 5% over the next 3 years. That's significant. Is there some downside risk? Potentially. We've had Q1 misses already. What are the hotspots in terms of the new projects? DRC, Peru, and Russia. COVID suspensions are easing, South Africa being the epicenter, so that's not an issue, I don't think, in terms of the copper supply concerns during this year. And as I've said, Q1 miss, it is early days, but we've already shaved 100,000 tons off of the first quarter numbers. But as I say, you know, year on year numbers are clearly going to be higher. There's a lot of material coming through the system. And I think, you know, the pipeline, I've obviously only shown you to 2023, 2025 and beyond because of the lack of investment during those lean years. And if Andy's story on the green economy comes through, you know, you are going to have a crunch. You are going to have some major deficits in this market. But we're not here to talk that far in advance, so I'm handing over the mouse to Bernd. Thank you for your attention.
Thanks a lot, Bruce and Andy, for those insightful presentations. I will now briefly, after we've seen quite a bit of insights into the fundamentals of the copper market and the broader macro perspective from Andy, I just want to give an update from the LME side of things, what we have seen, both in the futures and options markets, as it's certainly been a very interesting start to the year. So let's get into it. So first section, just a brief overview to put things a bit in perspective where we are in the copper market against the other base metals. The second part, I want to give you guys a bit more understanding about the LME implied markets, which are also known as the third Wednesday contracts. Obviously, most market participants are very familiar with the 3 months forward contract, but obviously we have seen some very strong interest on the implied markets as well in 2021 so far. And then we'll just round up looking at the options market. Obviously, that's something that's always of interest when you have some decent volatility in the market. So let's start off with a polling question. So this is just kind of what is the narrative? What do you think is the dominant narrative driving copper prices higher so far in 2021? So the classic, is it inflation expectations? Is it increased copper demand from electric vehicles? Is it commodity index fund capital inflows? Or is it just generally the global central bank stimulus, the money printing we've seen on an unprecedented scale? So let's give it about 10 to 15 seconds. Everybody can digest the question and options to answer here. About 60% of the attendees have answered. Don't be shy. This is all anonymous. You won't be graded on your answers. We're just interested to see where the majority of the participants think, what's the copper narrative. Okay, well, yeah, we've got about 75%. So let's see, what the verdict is here. So interesting, inflation expectations actually only less than 10%. Thinking that's the narrative, and then we've got obviously the EV story. Maybe from the previous two presentations that was mentioned a couple of times. That's 40%, and then the commodity index fund inflows comes in, at 20%, and the central bank stimulus 30%. So interesting that there's, a variety of views what is driving the copper market, and let's keep those answers in mind, I guess, as we progress through the presentation, then further on into the panel. Okay, let's kick off with the market overview, and here I've just basically indexed the LME base metals from January 2020. And that was updated yesterday on the 27th, so obviously prices have moved. But basically on that day, copper and tin were kind of head-to-head, up 59% since Jan 2020. Strong outperformance against, aluminium at 33% up, zinc 26%, nickel at 19%, and lead at 8%. So clear divergence there, and we shall see how this develops further. But it's just interesting to see that there are different price movements within the base metals complex, so they all have a different underlying fundamental sets of variables that drive the prices. But as we've seen, copper and tin for now are really leading the pack here in terms of the positive price performance. Volumes, classic chart, I guess, from the LMEs. Here, the average daily monthly copper volume, a pretty sharp increase in February this year, then March and April a little bit lower, and I would say in general so far a little bit lower participation compared to, I would say, the 2018 and 19 period. But I think we shall obviously see how we progress here. But it was good to see, at least in January, a very strong month for us here on the future side. So these are just the volumes on the future side. Now let's dive into the implied markets. I think it's a very interesting topic, and I think not everyone in the market is really too familiar with those contracts, so the third Wednesday contracts. And here I know there's a lot of information on the slide, but I'll just take you through an example. Obviously, the 3 months forward is the contract with the most liquidity if you want to take a position in the copper market. But now, obviously, there's all increased demand to trade the third Wednesday contracts as well. So instead of having to trade your 3 month contract and then rolling that to, let's say, the August date or the September date, you can do that actually, but just directly trading the implied markets. And this example here is we built that slide a couple of years ago, but it's equally applicable to 2021 contracts. And what it means is we're basically taking the 3 month liquidity, which is the most liquid part of the LME forward curve, and we also look at the spread from the 3 month date to the respective forward third Wednesday date. So it could be now it's 29th of April, so it will be trading, end of July is the 3 months. But then if I want to trade August, I would look at the 3 months to August 2021 spread, and I could then infer or imply a August outright price that I could trade directly on LME Select. I.e., instead of trading 3 months plus doing the roll adjustment, I can trade directly the August date, which obviously is then just one execution rather than trading the 3 months and potentially having to trade a carry as well, or doing the carry over the phone in the inter-office market. So that is just a brief highlight, an overview of how we're doing this. And as we can see, the advantages as well, that your implied third Wednesday prices become a lot more liquid because we're utilizing the 3 month liquidity order book in addition to the liquid carries that we have on Select. And let's have a look here. And what we've seen in terms of volumes, obviously this is not comparable to the 3 month forward volumes, but we've seen a record month right out of the gates this year in February. And, it's just been an extended growth story in terms of volume since the launch back in July 2018. And it's in terms of copper volumes for the implied markets, we've seen a year-on-year growth of 7%. And obviously there are some fluctuations in those markets in terms of the monthly volumes, depending on the volatility of the markets and also interest in putting the carry liquidity onto LME Select. As I would say, there's still a large majority of the volume for the carries transacted in the inter-office market. But nevertheless, it's good to see that there's continued growth and interest for the implied copper markets. A couple of other interesting metrics here. We've plotted the bid-ask spread from 9 a.m. to 5 p.m. Trading time, UK time zone for the third Wednesdays. So the 3 months gives you around a bid-ask spread of $2.64. If you were to trade the first third Wednesday after the 3 months, as we said, that would be the August date. You have a small uptick really in the bid-ask spread. If you were to trade the first third Wednesday before the 3 months, it would be your July date, and then your June date and your May date. So obviously, as you drift away from the 3 month date structure, around the prompts around the third 3 months contract, you will see an increase in the bid-ask spread. But if you're just keen to trade around, the first Wednesday after the 3 months or before, your bid-ask increase that you'll have to pay is fairly negligible. So I think that's a good sign and just shows the sort of competitive liquidity that we've seen in the implied contracts, where we've enabled the implied functionality. In terms of, the spread, we've seen that as well. The drop-off here is on an hourly basis again, and then the spread quoting of those third Wednesday contracts is pretty much 100%, or whatever, 95 to 100% throughout, the core trading time in the UK time zone. So that just should encourage everyone to at least consider potentially trading the implied markets, the third Wednesday contracts, as you have both a pretty attractive bid-ask spread as well as continuous liquidity in the order book. Now, just in the final section here, we're going into the options markets. Brief overview here again on volumes across all base metals. So we've seen a pretty strong uptick in terms of the open interest in Q1. It's almost getting on par or exceeding what we've seen in April and May last year, when obviously the metal prices were hitting the lows during the peak of the COVID pandemic in 2020. In terms of, just focusing again on the options and the tappers for copper, we've seen the open interest was up 10.5% in Q1 this year compared to last year. And in March 21, open interest was up 5.8% year on year. And we've hit a pretty decent volume, sort of a record volume as well in February over the last sort of 2 years. So pretty good interest there as well on the option side. Here we're looking just at the monthly ADV again, and I've overlaid for you here the percentage of call options that have traded in the month as a percentage of the total options. And, we've literally hit a high in terms of call options traded in April so far. It's 75% of all options that we're trading were call options. So definitely, I think, just potentially confirming what Andy's initial poll showed, whether prices will be higher or lower. That is certainly something we're seeing in terms of a very high number of options that are traded are call options. And what I've just mentioned, in February we've hit, a record high in terms of option ADV in copper since October 2017, as the copper price at the time had reached a 9.5-year high. So good participation here, and we will see how this continues going forward this year. Just briefly rounding up here, what sort of strikes were in play in Q1. So we've seen calls trading between $8,500 and $12,000 strikes, and puts from 8,000 down to 6,800 here on this particular chart. So I would say a good diverse view again, both to the up and downside, but clearly some early movers who had purchased people have purchased options ahead of this sort of $10,000 level that we almost hit today. So it just shows you that the liquidity and the breadth of the market is there. If somebody wants to transact very far out of the money delta options, that is possible in the LME options market. And the last slide here, we're just looking at the overall at the money front month implied volatility. We've seen that rising, pretty consistently. Copper is on the left-hand side here, pretty consistently in January and February. We've exceeded both 2020 and 2019 front month implied volatility in March. We were slightly lower than 2020, but still around the 30% mark. And then so far in April, we're a bit lower than what we've seen last year during sort of those peak months of the COVID pandemic. And with that, I think I'll pass it back to Andy for the panel discussion. Thank you very much for your attention.
Thank you, Bernd, and thank you, Bruce, for great presentations. I have questions for both of you, but I really want to bring Aline into this conversation, who's been sitting there very patiently. Aline, maybe just by way of introduction, could you explain a little bit about Parla Investments for those that may not be too familiar with your company?
Sure, happy to. So, Parla Investments, we are an investment firm focused in the raw material supply chain. We have two large arms of the business. One is the private equity, where we invest in mines and supply chains. And the other is the hedge fund, where I mostly work on. I manage commodity investments for the hedge fund side, and this is basically a total absolute return fund that we have.
And let me just put this question straight to you then. I mean, where does Parla, where do you and your colleagues sit on this "are we in a super cycle" question? Is that the way that your conversations at Parla, are heading?
Yeah, definitely. So this is always front and center. The answer, I think it is yes. If you define the super cycle as a step change or a paradigm shift in the demand for copper, I think we're definitely there. The fact is that the past 10 years, whoever's been in the business, China has been, as you mentioned in your presentation, the only game in town. So you really came through like this boom and bust periods that was, not as easy for us that was, managing money in this industry, which was all about, Chinese policy and are they leveraging, are they deleveraging? And now we have a various thematics that is bringing the demand to another step level, and that's what we've defined as a super cycle. So what are those scenes? Finally, I think China will not be the only game in town. It will always be a very important driver of copper demand, but now you're adding other layers that are structured. And in that, I kind of agree with Goldman Sachs' views that inequality is very important. Taking the U.S. as an example, the last time that we had the 1% owning so much of the wealth in the U.S. was 1929, where we actually got the New Deal by Roosevelt at the time. What we're seeing now is very similar policies that are mirroring that, 30s New Deal, and that's what really triggered the middle class. And when you invest in middle class, you really invest in commodity-intensive sectors. So that's one. Second one is decarbonization. I don't think it's just hype. There are actually tangible numbers that we can discuss our views in each sectors, but this is adding at least 1.5% of demand on top of the natural, normal copper demand. So might not seem that much, but that means that you have to bring copper being so inelastic supply, you need to incentivize a lot of scrap to come into the market, particularly after that. So that will give another step up. And finally, underinvestment across the West in infrastructure. So we're looking really, take aside the decarbonization side, just to maintain the current infrastructure, we will have to, at least in our numbers, increase by 4 times the investment that you had in copper-intensive sectors, be that the U.S. grid, be that, transition lines here in Europe as well. So those are drivers that we do think like is just giving copper demand a more diversified demand source and on total level increase as well.
Thank you. And maybe just, I don't want you to give away the family secrets here, but when you kind of formulate a view like that about a market like copper, how does Parla sort of think about playing that cycle? Is it just futures positions? Is it something broader? It sounds like you have a very strong view about this market. And I'm just kind of interested in how that manifests itself in terms of your sort of strategy.
Yeah, so the strategy that I apply, for example, on the fund is it's a little bit a term, I call it quantamental. So how does it feel like our longer term strategy defines the trend and the bias that we want to trade the market? So Am I, in very simple ways, am I buy the dip or am I sell the rally person? If I am buy the dip, then we have a big data system here and an artificial intelligence algorithms that help us pick the medium-term cycles within the larger bull trend and the mini cycles defined by technical indicators. So what are medium-term cycles like? Leading indicators on demand, how stock actually end consumers are, what is the arbitrage between the LME and the SHFE? Is material come back from China and get into LME? What are the physical premiums? What are the actually tangible economy is going to do in the short term? And technical indicators, we have this intelligence that helps me understand when the quants fund are going to go in. So as we know, these markets are now traded quite a lot by algorithms. So we got to monitor, okay, if we break certain levels, we know there will be some volumes coming in. So sometimes we get really lucky. Those three indicators fall into buckets and it's a green and it's a great investment. Sometimes it's a mixed picture. Maybe positioning is too high already and the market is positive, but it's priced in. So that's how we manage.
And would you express a bull view on copper, say, also by taking equity positions in miners, or is it very much just onto the futures exchanges?
No, we do equities, we do futures, we do options, and obviously we also have the private equity investments in miners, which are longer term view. So
thank you. Now, I mean, one of the questions that's coming through for me, the audience, and I think it kind of, it's very topical at the moment. There is a perception around, I think, in the copper market that this is really just being driven by fund players, that traditional end users, the industrials, are not fully participating in that. And I wanted to ask Ben, when you look at the data that you're on the LME, can you get any feel as to whether this is being driven by funds or whether it's being driven by traditional players, or what combination of both?
Well, I think it's a very good question. You know, I think the best way probably one would evaluate this is probably looking at the commitment of trader reports that the LME publishes. So I cannot discuss in, I would say, detail what is really driving this. What I can give an overview is pretty much what sort of client types do we see on the whole participating on the LME, because I obviously look after our buy-side clients in EMEA and the Americas. So definitely, as Aline alluded to as well, so there's definitely a discretionary component, discretionary traders, and your sort of more systematic outfits, you know. Start with the discretionary. That could be a pure macro fund who wants to take a view on copper as a broader macro story. That could be even pension funds allocating, or endowment funds, high net worth family offices might be allocating on a discretionary level towards the copper market based on their macro view or their fundamental view, as Aline has just alluded to as well. And then the other component on the buy side is certainly the systematic side of the players. So, you know, predominantly known as CTAs, these are funds which have systematic models, and then based on a certain indicator or algorithm that they've devised, they will either buy or sell the copper market, and the holding periods as well can be, from short term to very long term. So I think it's a good sort of broad mix of participants. And again, that's just covering the buy side, not to forget, obviously, the large, extensive community of physical market participants on the LME, which also are executing and trading the copper markets.
Thank you. Let's bring Bruce in here a moment, because Bruce, you said something that sort of sent little shivers down my spine, which is like when you talked about the lack of investment for copper mine growth after 2025, and you say we could be sleepwalking into a supply crunch. I mean, what interests me at the moment, is when I look at the big miners out there, no one seems to be investing in holes in the ground. Everyone's still paying back dividends to their shareholders. We seem to be stuck in a sort of like the last 10 years behavior there. I mean, how do you think that's going to pan out? And do you basically agree that the miners should just start digging?
Yeah, thanks, Andy. Yeah, absolutely. I mean, I think we know that, price dependent, there is not a shortage in terms of resource. If you're talking, copper porphyries, what is on the books, what is available, and what is kind of, has already been drilled out to a certain extent. The grades are perhaps not the best, and they would need higher prices than, the 7,500 incentive price for new mines that I mentioned and everyone, nailed in the quiz, is essentially the existing kind of stock of mines where we have a good sense of the cost of development. So you've got feasibility, pre-feasibility. I know it's a bit dodgy, but that kind of group of mines is kind of that price is driven from that set of mines. There's another set, of course, on top of that, which would need a higher price, but there's no shortage of material, and obviously scrap would come into play a little bit more, I think, as Aline mentioned. So I think definitely, the miners have been under pressure because on the last upcycle, they all lost money. I mean, no, I say they lost money, but I mean, the returns for the equity investors were not just there, I mean, capex inflation swallowed away a lot of the returns that should have been given back to investors. So now, of course, in the boardrooms, they're much more conservative and holding on. And as you say, Adam, Andy, paying back in dividends rather than investing in the ground. So I think, that kind of alignment is wrong, clearly, because, I mean, if you are going to invest for that supply deficit, which is coming, no doubt, 2025 and beyond, you have to start digging now. I mean, what is a development timeline? The DRC was perhaps faster than usual, but I mean, the Ivanhoe project, but I mean, 5-6 years, these are big assets. The infrastructure is complex. Often they're going to be in remote locations. So it's going to be high capex. It's going to have a long lead time. Environmental, legislation and, getting it on board is going to be tougher. Although I'm guessing to alleviate supply, that could ease up a little bit in some jurisdictions, US maybe. So I think the scenario is it's tougher to get these, decisions, these investment decisions to the boardroom because of the, the poor records and the capex inflation, which is, of course, part of that super cycle, right? Everything goes higher, including the cost to build a mine. And even in the cost numbers, we've got the Q4 numbers finished off. You can see a 50% increase year on year in depreciation. So in other words, the sustaining capex to maintain the assets. So it's a lot of capital still going in just to stand still, although costs are essentially flat. So I think you're beginning to see, some kind of underlying cost acceleration there as well, which will start to play out. But they need to build mines, Andy.
And I want to sort of put an add-on question. When I overlay what you're saying about the normal cost of building a copper mine with the new ESG sort of costs around that, my question is really, do shareholders in miners, the big miners, need to change their attitude? I mean, obviously the boards are dependent on what they hear from the shareholders. Are shareholders asking for the wrong things from the miners, Bruce?
What you mean are we talking kind of the ESG footprint?
Yes, exactly.
Miners?
The shareholders themselves are sort of pushing for dividends or higher dividends. They don't want, as you said, they've been burned once on the investment. But it strikes me that, as long as shareholders in the likes of the BHPs and the Rios keep thinking that way, we have a supply problem, right?
I think so. But look, as I mentioned, if you look at the involvement from China in terms of direct investment into mines through, well, they're in the DRC, they're in Africa, they're in PNG, they're in, they're building out a lot of portfolio as well. So I think China is going to be putting a lot of money into mine investment as well, certainly in Africa, especially in Africa. Okay. So there's a bit of an underpin there, I think. And maybe ESG is not so high on their agenda.
Yeah, I'm a little bit aware we're on countdown time now, but I want to bring Aline back in because it's quite obvious that, I mean, you know, as you said, you share parts of Goldman's view about how this recovery is shaping up. I wanted to ask you, what could go wrong? What could go wrong with our view that, I mean, the world is going to be greener and it's going to be using more copper, and you know, the sunny uplands of a $15,000 copper price is just around the corner? What worries you about that scenario?
I think like what could be a black swan. I would like to think that decarbonization is not one of them. I would like to think that we have, as a society, reached the agreement that this needs to be done faster than slower, and is serious. But a good idea would be something like what happened to nickel, which I call the Nickel Gate, a supply technology that improves the way that we process copper. The truth is that we haven't had any technology breakthrough in copper industry in the last 30 years. And there are available technologies there that you could see helping the recovery rates of these mines, such as image recognition, content recognition. So there is a lot of new technology investments that could improve more than we are forecasting the response of the supply. And I'm a true believer of human capacity to respond to challenges. So I think we have to always keep that in mind.
And just, you know, one of the conversations around EVs is coming from the lithium market, where there is a genuine concern that lithium supply will be so problematic it will actually hold back the EV revolution. Do you think there's the potential for copper to have similar issues, say, I mean, over a 5 to 10 year time horizon, that we simply will not have enough to supply the green economy?
No, I think the price will incentivize mines to come in. I think scrap will respond to higher prices. Then we're going to have substitution. I mean, copper to aluminum, as we had it before. I do think we reached the goals at the end. Whoever worked as much as we have on the commodities markets know that we find a solution as a society, but that solution often means that prices need to go higher more than people expected. But I don't think it holds back the supply chain. Just as
a follow-on, I kind of told you my experience in the 1990s when everyone was convinced that $3,000 per ton was a natural cap to the market. We're now very, very close to $10,000 per ton. Aline, what sort of like scale of price increase would you be looking at from here? And I don't want to put you on the spot, but I mean, are we kind of at the top of this part of the cycle, or do we actually have a lot more to run, which I think is what Goldman, if I'm paraphrasing Goldman, is contending?
I think it depends on your timeline. So if we're looking structurally, particularly after this supply increase that was mentioned here, the 23-24 supply that it's already in place and will come in, I think we're still looking at structurally higher. It might be mini cycles within that. Obviously, copper at 10,000 is not necessarily cheap right now, but structurally, I believe that I challenge the 7,500 number coming from the investment side, because first, on average, the mine plan to actually tangible costs, you increase anything between 30 and 40% from the feasibility studies to the reality. On top of that, if you're forward looking nowadays, you would add at least another 10-15% of ESG costs related to that. And we know that fiscal policies are a big part of this recovery. It doesn't come as just a positive influence. We have to expect the royalties will also increase in the near term. So do I think we need higher prices, particularly for the second wave of supply? I agree. I do think so.
Thank you. Thank you. Now, I'm aware that we're running out of time, and we have got there are more questions from the audience. As I'll repeat again, all your questions will be captured, and I think there's a couple for you in there, Bruce, which maybe we can send to you later. So I'm going to wrap things up now, and I just really want to thank Aline, Bernd, and Bruce for participating. And just a reminder to everyone, that has been recorded, that you can sort of come back in and watch this on demand. And on behalf of Refinitiv, please do fill out the opinion poll survey at the end of this. I hope you've enjoyed it. It's over from us here. Thank you.